clients and guests, thank you very much for joining me today. This recording is a recording of a presentation that we did just recently on navigating COVID-19 opportunities, risks, and lessons learned. Just a brief content, what we will be talking about, just a brief introduction of Schwaben, meet the team, brief timeline, the current situation, the US, the new government and possibilities, the Canadian impact, interest rates, equities, new world, new valuations and opportunities. Brief introduction to Schwaben. I established Schwaben 10 years ago for the reason that I didn't feel that larger firms really provided the platform and the attention to clients, especially affluent clients, what they were requesting, what they needed. Was a response to an overcrowded field. We're fundamental based investors. We do a broad range of services starting from investment and wealth management. We offer corporate finance and advisory services to entrepreneurs. We do estate planning, executiveship, life insurance, and family office services. Brief overview of who we are. Myself, Albrecht Weller, I'm a CFA. I've been in the business for over 30 years. I've held a number of different positions with the largest financial institutions, including RBC and BMO Nesbitt Burns. I've managed family offices for ultra high net worth individuals over the last 10 years. Martin Haefele was one of my clients. He joined me at the beginning of the firm, helped me organize the firm and started the firm. He is now our advisor for ultra high net worth individuals and shares his experiences from his own family. Martin is a member of the Haefele family who owns a $2 billion enterprise that does business in 40 countries around the world and has offices there. Hamza joined us earlier this year. He's our vice president and associate portfolio manager. He helps me with the day-to-day operation and with marketing and business development activities. He's also on our investment committee. Brief overview of the timeline. In December 2019, when Li Wingling, a Chinese doctor, had mentioned of a SARS-like flu that had significantly impacted, that could significantly impact the health for individuals worldwide, and he expected that this could turn into a pandemic. On January the 9th, Wuhan shut down the entire city. February 12th, death toll surpassed 1,000 people. This was more than MERS and SARS individually. On February the 12th, the Dow hit a high of 29,551. No one had really taken COVID-19 seriously yet. Over the next 5 weeks, the Dow Jones dropped to make a record low of 18,231. This was the lowest point since November of 2016, very close to 18,333. At that point, the US government announced a $2 trillion stimulus package in order to help the economy avoid a catastrophic collapse. On March 24th, 400,000 cases had been reported worldwide. A week later, cases had surpassed over 1 million people. Unemployment spiked. At the beginning of April, unemployment was at 14% or in excess of 14%, and COVID-19 cases continued to escalate in an alarming rate. Going fast forward, August 22nd, we have now 23 million cases and 800,000 deaths. On August 24th, the University of Hong Kong reports the first reinfection of COVID-19. September 2nd, the S&P hits a new high. People seem to have forgotten that we are in a pandemic at the moment. I think a lot of that had to do with technology and with enthusiasm that we had significantly lower interest rates. Something you will talk in a few slides. October 20th, Ireland and regional Germany had a re-lockdown, and Spain and Italy reinstated curfews. October 22nd, 41.5 million cases and 1.1 million deaths. The current situation, at least this is what we had until the end of September, middle of October. Cases are now at 200,000 cases per day in the US, 5,000 new infections in Canada. US had a total of 250,000 deaths and almost 14,000 reinfections. The colder weather, lack of vitamin D, weakened immune system, and COVID fatigue are definitely some of the key issues why we have significantly higher cases. 75% of all cases are in the United States, and India, Brazil, and Russia combined. Those four countries seem to be making up in most of the COVID-19. This is by far the worst pandemic that we've had over the past 100 years. To give you an example, the Spanish and the Hong Kong flu each that occurred in the 1950s and 60s had about 1 million cases, 1 million deaths. We're already at this point at 1.4 million deaths. Drastically worse, and we still haven't finished that yet, and we have rising cases again. The U.S. government, new government, new possibilities. Joe Biden was elected on November 3rd, and we expect a change in policies and change in government. The annualized return in a split Congress, which is widely expected, has been 13.5% over the last 40 or 50 years. If it was a blue wave, we only had 9.8% return. So I think it would be very beneficial if we had a split government. Gridlock will restrict Biden and the Democrats on implementing expansionary spending policies and in creating significant tax hikes. The gridlock also reduces a likelihood of additional fiscal stimulus. Biden's president won't escalate the China trade war, and it will normalize relations with its old allies. The leading cause of market volatility during the Trump presidency. The Canadian impact. 30% of Canadians are concerned that they will not recover from the COVID-related financial hits. We will see that in a lot of the smaller firms, especially in the service industry, that suffer drastically and have suffered drastically over the last 7 or 8 months. 1 out of 3 Canadians had to take on new debts or draw from savings. 42% of Canadians are not financially stable enough to endure a second wave. 2 out of 5 Canadians saw worsened financial positions during the first wave. This cohort is now 4 times more likely to state that their debt is overwhelming. 20% of investors were forced to change their lifelong financial goals, which are now deemed unattainable. Interest rates. It's a steroid for assets. Interest rates were 2.25% before the pandemic. On March 3rd, the Federal Reserve reduced interest rates to 1.75% and then to 0.25% on March 15th before we actually reached the bottom of the Dow. Interest rates have been at 0.25% since March 15th. The last time we had that was after the financial crisis of 2008 and 2009. 3 reasons why interest rates lead to higher stock price and asset prices. Cheaper financing of durable goods, houses, cars, etc. It means consumer spending still is intact. Purchasing power goes up because financing rates decline, meaning that individuals can buy more expensive houses. Fear of missing out. People are buying because they are fearing that there's going to be an increase in prices both on an inflationary basis and on housing prices. Lower interest rates and stock prices and bond prices yield costs result in a lower multiples and thereby higher multiples and thereby higher stock prices. The Fed has spent $2.3 trillion in T-bills. This is 20 times more than what bought during the 18 months period during the Great Financial Crisis. COVID-19 equities, unlike mainstream, Google, Amazon, Apple, Microsoft, and Google, and Facebook account for 23% of the S&P 500, which is up from 17% in January. While the S&P 500 returned 5.5%, it would have been down 4% without those stocks. The Nasdaq 100 returned 32% year to date. COVID only expedited an existing trend that that happened in technology. It accelerated that because everyone was required to implement social distancing, and technology made it possible to continue operating without too much interruption. These 5 stocks, Facebook, Apple, Amazon, Microsoft, and Google, accounted for 72% of gains, and 15% of the companies accounted for 96% of the gains since 2017. A new world, new valuations. Growth gap between large cap stocks and brick and mortar is rapidly expanding. Technology disruption deteriorates earnings of bricks and mortar companies, and COVID has just accelerated that. New technology and new infrastructure development spending further increases future earning growth of technology. This means faster and wireless networks, faster broadband, fiber optics, all that will just enhance the technology infrastructure and will allow technology companies to further expand their reach. At this point, only 62% of the world uses mobile internet. There's another 38% left. Another 38% would mean more than a 50% increase from where we are at this point. The transfer of electronic assets and data creates hyperscalability and revenue expansion. This means we can transfer data, we can do more with less cost. This is the biggest expansion that we will see in the next little while. COVID-19 opportunities. Air freight and logistics has been the biggest performer so far. However, will likely be number 2. Technology will be by far the biggest winner out of COVID-19. The growth outlook gap between technology and traditional brick and mortar is rapidly increasing. As indicated before, only 62% of the world has mobile internet so far. When they all come along, we will have significantly greater increase, because a lot of those countries that don't have that yet are developing countries, and the population in those countries is quite drastic. Air freight and logistics will increase because of the technology, because consumer spending, because of companies like Amazon's, because companies still need to deliver the goods and services somehow, and that is why air freight and logistics will continue to grow. Industrial real estate, data centers, storage facilities, inventory facilities are all required in the new economy with more technological in e-commerce. Biotech will be another big area of additional increase. So far, most of the medical pharmaceuticals have been chemical pharmaceuticals. Biotech will allow us to create more effective drugs and create vaccines and medicines and treatments that will far outweigh what was possible with conventional pharmaceuticals. And last but not least is consumer discretionary. That sector will likely still be lagging a bit. We would expect that if there's an additional another increase in another spike of COVID-19 cases, we would expect that consumer discretionary will be hit again. But at that point, once we reach the bottom, that will have an immense opportunity for consumer discretionary spending. Thank you very much for listening to us.